How's it going, everyone? It's Sam. I want to go over a beginner's guide to investing. Now, I'm going to take you through a lot. I'm going to talk to you about what to look for in companies, what to look for in investments, what are index funds, what are swing trades, what are option plays, what to look out for, what to pay attention to, what you should know before you start investing. Now, I think this is going to be really important and really good for newer investors, but I think investors that have been doing this for a little while will still pick up on some really important aspects of investing. Now, of course, you should know I'm not a financial advisor. I'm not a professional stock analyst or anything like that. I'm just a guy that wants to bring to you some of the information that I've learned and hopefully help you expedite your own researching process and your own learning process. So if you guys don't mind hitting that like button before we get started, that helps out a lot. If you guys feel like sharing this to anyone else you know, that helps a lot too. So let's get into it here. So first of all, why should you invest in stocks and how do you actually make money? Well, first of all, the main purpose of investing in stocks is compound interest. Now, I know a lot of people have heard that before, but a lot of people don't necessarily know what that means. So definition of compound interest is the addition of interest to the principal sum of a loan or deposit. So it's interest on interest. Now, how this works out is, let's say you accumulate investments for 40 years, and let's say you get 9% return a year, which is pretty average for index funds, and you put in $5,000 a year. Well, after 40 years, you have $1.68 million, $1.68 million. Now, you have not invested that much into it, right? It's compound interest that takes it away because at this point, you've only invested about $200,000 into this investment, and yet you've about 10x your money. So by the end, you're getting 9% on this $1.68 million sum as opposed to 9% on $5,000, which is not even close to how much you're making at the end. So compound interest, it's like a snowball that is going down a hill. It picks up more and more snow as it goes on. So that is the main purpose of investing in general. Now, why should you actually pick stock market investing? Well, there's a very low barrier of entry. So you don't have to have tens of thousands of dollars. You don't have to have hundreds of thousands of dollars like you might have to in real estate. It's a little bit more hands-off, so you can make it very hands-on. You can day trade or you can swing trade, which we'll talk about that here in a second. But you can do all that, or you can just buy and you can hold on for as long as you need to. You can hold on for 10, 20, 30 years and never look at it again. So it's very hands-off, or very simple, I should say. So it's very simple. If you just buy and you don't touch it, you don't have tenants calling you up, you don't have, taxes to pay in terms of like business taxes and stuff like that. You could just buy, hold, and forget about it for a while. Now, there are taxes that will come into it, and we'll talk about that here in a second. But the thing about stock market investing too is it's very liquid. So what do I mean by that? Well, you can buy and sell from your phone. You can do it at just about any time, unless you have massive amounts, which if you're watching this video, you probably don't have tens of millions of dollars that you're trying to sell out of a stock. But you can sell it and buy it very quickly, very easily. It's not where you have to go get a realtor and then go through a whole buying process. You just have to sign up for a broker and then start buying. Now, what are stocks actually? A lot of people don't even know what a stock is. They've heard the term stock, but they couldn't explain it to someone. It's owning part of a business. So let's say I wanted to sell a table making business, and I wanted to sell shares of it. So each part of the business is called a share of stock. So let's say my business is worth $10,000. We figure that out, and I have 10 shares. That means each share is worth $1,000. So if I sold it to you and you paid $1,000 to me, you could own 10% of my business. So if I start earning a good amount of money, you might get 10% of that money. So why do companies actually issue stocks? Because this is not the easiest process. This is not something where, okay, I go make tables and then all of a sudden I can start selling shares of my company away, especially publicly. So why do companies issue stocks? Because they actually want to raise money. So it's great to be able to have this company that earns a lot of money, but maybe one day I don't want to work in it actively, or maybe we want to go build another building. We might issue shares of stock. So another way that they could do this is by getting a loan or something like that. But issuing shares of stock allows them to raise capital a lot easier in the future. So they don't have to go to a bank and give them all these financial documents and do all this other stuff. They would just issue more shares. Now, of course, there's stuff that goes into that too, but that is why companies issue stock. It's to raise capital. What causes stocks to go up and down? Okay, this is something where I know personally, I used to watch certain stocks and I'd think, why is this up 3% today? And I couldn't figure it out. Sometimes there are fluctuations in price that you cannot tell why they're happening. Maybe it's just someone buying, maybe it's someone selling. But oftentimes if there are big jumps, it's because there's some news, either from the company or from analysts that cover the company, or from something that's happening in the market that they're in. So let's say Bitcoin goes up to 100,000 and I own a company that mines for Bitcoin or that owns Bitcoin. You might not necessarily see why this company is going up dramatically, but if they hold a lot of Bitcoin, the value of the company is going up. So that is one reason that a stock could go up or down. A lot of the time, again, it just gets back to whether the company is increasing in value or decreasing. The reason it goes up or down is because people are buying or selling the shares. So if it goes down dramatically, people are probably selling the shares. And if it goes up dramatically, people are buying the shares. Why the price of stock doesn't actually matter is something that a lot of people don't understand. So I hear this all the time, like, oh, this stock looks cheap. It's $10 a share. Or that stock's so expensive. It's $1,000 a share. The number of shares times the price of the share or the price of the stock is what makes up the market cap. That's how much the company is worth. And a lot of people don't understand that. I heard someone say, this company is so cheap, it's $20. That doesn't matter. The price of the stock doesn't really matter. And while some retail traders like stocks that are a little bit cheaper because it's easier to buy, like if you want to go buy 10 shares of a $20 stock, it's a lot easier than buying, $1,000 stock, especially if you can't buy something called fractional shares, which is basically partial shares. So the price of the share or the price of the stock really doesn't matter though, because let's say I have a $10,000 company again. I could issue 10,000 shares or I could issue 10 shares. That would change the price of the share, but the company is still worth the same. So overall, when you buy into a stock, you're buying a percentage of the total company. So again, if I issue 10,000 shares of my company that's worth $10,000 and you buy one share, that's going to be worth a lot less and you're going to own a lot less of the company than if I issue 10 shares and each share is worth $1,000. So you have to look at what's called the market cap, which is the number of shares times the price. That tells you how much the company is actually worth. We have to talk about what you are actually putting your money in. So are you putting it into an individual brokerage account? Are you putting it in an IRA, a 401k, some other kind of plan like a 403b or 529 plan? So what you are actually using the money for, the investing for, will kind of determine what kind of brokerage you put it into. Now, of course, what kind of account you're putting it into. So in the US here, we have different accounts than a lot of other countries, but generally you want some kind of action plan why you would invest in a brokerage account or an IRA or a 401k. There are all different perks to each one. There are all different drawbacks for each one. So a brokerage account is just like you make $100, let's say you get taxed $20 out of that 100, and then you go put money in this brokerage account, and then whatever you make, let's say you put $80 in it, then it goes up to $180. You would have to pay taxes when you draw that money out based on how much you earn. So again, that example that we just had, you had $80, you made 100, and then you have 180. So 80 is the original, 100 is the earnings. If you drew all that money out, you'd have to pay taxes on that $100. And depending on how long you've actually held that, how that stock, it changes how much you have to pay, what percentage you have to pay in taxes. So it can be a little bit complicated. After you get it down, it's not very complicated at all, but it's going to be a little bit more than we want to talk about here today. Then an IRA is an individual retirement account. So you can have traditional IRAs, you can have Roth IRAs. So the main difference between the two is that with a traditional IRA, you don't have to pay taxes now. So if you put money into a traditional IRA, you actually get a tax benefit this year. But in the future, when you pull it out, you'll get taxed then. With a Roth IRA, you pay taxes now, and then when you take the money out later, you won't have to pay taxes on it. Now, with both of these, you have to wait until a certain age to be able to take out the proceeds or the gains on it. With a Roth IRA, you can actually withdraw the principal. So whatever you put in, you can withdraw that before age 59 and a half or 60. But with the traditional IRA, you do have to wait the whole time. Now, with a 401k, that is basically a company's plan for your investments. So you put money in. Typically, it's a traditional 401k, which is, again, you put money in. It benefits you this year in terms of taxes. And then in the future, when you withdraw it, you'll have to pay taxes then. The real reason to invest in a traditional versus a Roth is whether you think you're going to get paid more in the future or now. So why do I say this? Well, if you get paid $30,000 right now and you think by the time you retire, you're going to be pulling out maybe $50,000 or $60,000 a year, or maybe you're not making much money now, but you think, okay, years down the line, I'm going to make a lot more in my job because I'm going to rise up the ranks or something, then it makes more sense to go Roth IRA typically, or Roth 401k, because you're paying taxes now and you'll pay less taxes because you aren't making as much typically. And then down the road, you won't have to pay taxes when you're earning a lot more and you have to pay a higher tax amount. So that is just a very brief discussion on that. Of course, always consult your tax advisor or tax professional. And then we won't get into 403Bs or 529, but there are other tax advantage accounts that you can take advantage of. So picking the right broker. A broker is someone that helps you buy your stocks essentially, or buy your assets. What are you actually looking for is what will determine what kind of broker you're going to invest on. So for example, I oftentimes use Webull. So there is a link down there in case you want 2 free stocks. All you have to do is sign up and then deposit $100 on their platform. I really like them. They allow you to invest before the market opens and after it closes. So the general stock market is open from 9:30 a.m. Eastern time up till 4 p.m. Eastern time. But there's something called the pre-market, which is open from about 4 to 9:30. And there's something called the post-market, which is open from 4 p.m. to 8 p.m. So a lot of the time, these brokers won't allow you to trade on it. Webull allows that. Fidelity also allows it. There's some other ones too. If you're someone that likes investing and not really looking at your investments too much, or having to sell and buy on a daily basis, like if you're just focused on long-term investing, M1 Finance is a great broker. They allow you to buy once a day. If you upgrade to a different part of their platform, you can invest twice a day, and then you're not worried about the exact price. You're not getting in your own head, and then you just buy and hold longer term. Now, all these brokers have different benefits and different cons to them, so you always have to look at what you actually want long term. I would just make sure that you're not paying. Many of these companies don't actually charge you anymore to invest with stocks or invest in stocks, so just make sure that they don't have any trading fees or anything like that. From there, you can take a look at what kind of brokers are available in your area. Different countries allow different brokers, so just make sure you know what's available to you. Then let's talk about how to actually find stocks. So first of all, it's important to start with companies you understand and you know. It's going to be very difficult if you start looking into pharmaceutical stocks right off the bat, because there's a lot going on. They're very hard to understand. But if you start with something like Apple stock, a lot of people know what Apple is. A lot of people understand what makes Apple valuable. Their brand and their sales, right? If they sell a lot of products, that will be great. if their brand continues to stay really well thought of, that's great for them too, right? If something happens and they decrease sales or their brand recognition goes down or something like that, it's going to be bad for the company. But overall, it's pretty easy to understand what Apple does. They sell a lot of products. They also have some services that they sell on a monthly basis. Then you can also join communities of other investors. For example, I started a Patreon account. So right there are over 2,400 other people that are invested and invest on a daily basis, weekly basis, and they're all in one community, and we've connected it to a Discord. So a Discord is just Discord in of itself is a chat group. So in there, people talk about investments all day long. So if you guys want that, there is a link underneath the video. Otherwise, you can just surround yourself with other people that are interested and invested in stocks, right? You'll pick up on a lot just from being around other people that like stocks like you do. And then you can take a look at websites, certain websites like Yahoo Finance or Seeking Alpha or the investor relations page of different companies. And I apologize for some of the grammar in here too. But from there, how do you actually look into a company, right? How do you look into a company? First of all, you need to look at the industry, right? So let's take an example here. So we're going to look at Tattooed Chef. So if you don't know what Tattooed Chef is, they are a company in the plant-based foods industry. Plant-based foods is increasing. The total addressable market is increasing. More and more people are interested in this for various reasons, right? Generally for health reasons. But we can take a look here. You can always look up the ticker symbol or the name of the company and then put stock behind it. So the ticker symbol is just a 4-letter moniker, a 4-letter identifier for the stock. So it makes it a little bit easier to find. So TTCF is the ticker symbol for Tattooed Chef. This is a public company. From here, I like to look at the price action. That's one of the first things I look at besides the industry. I want to know what the stock or what the company actually does. I want to take a look at the price action, right? What have they done? Are they down significantly? Are they up significantly? That gives me a general idea of how people are feeling about the company. Is it doing really well? If it's doing really well, if they're increasing sales or there's something exciting, the price is probably going up. If something bad is happening, then the price is probably going down. Now, just because the price went down doesn't mean I won't invest in it. Some of the best times to invest in companies is when the stock price goes down because you're buying it for cheaper. There might be various reasons why the company is down, and you might think that they're not good reasons for it to actually be down. Let's say Tattooed Chef goes out there and says, hey, we want to raise some money. We want to issue $1 million worth of new shares, right? So $1 million is not anything compared to their market cap. That's $1.8 billion. So it would be like one out of every $2,000 they would be putting new shares in for. So I realize that's probably not the best way to phrase it, but basically they are just issuing a very small amount of shares. Let's say the stock drops 5% on that news. That's probably not a good reason for it to drop 5%. Sometimes investors overreact to news. So from there, I like to see, okay, what is the price doing? Tattooed Chef is up 70% in the last year. People are excited about it. Okay. And obviously this can change. If the whole year it's at $10 and all of a sudden it shoots up to $200, maybe you don't want to invest in it because it's gone up so much so quickly. So I just like to get a general feeling for the bullishness or the bearishness of that company. Now, bullishness means how much people are excited and how much people feel like it's going to go up. Bearishness is when people think it's going to go down. So from there, I like to take a look at the company. So I'm going to Seeking Alpha. I have Tattooed Chef. I searched up Tattooed Chef. We can take a look at the financials. So overall, we know the market cap, like I said, back here is $1.8 billion. Sometimes it shows up slightly differently. Like on Seeking Alpha, it said $1.88 billion. It's relatively the same. It's pretty close. Okay, so we know that Tattooed Chef has not been public for a very, very long time because it stops in 2018 here. You can take a look at their revenue. So how much is the company bringing in before all their expenses? So it went up pretty drastically here from 47 million up to 84 up to 148, and then up to 168. So maybe it's not increasing as much as last year because of the pandemic or something like that. We can take a look at the gross profit. Basically, I want to see these numbers going up, and then I want to see how much they're going up. Or if they're going down, I want to know why they're going down. From there, we can take a look at net income. So net income is the money after all the different expenses. So this is how much the company actually earns after everything else. So right here we can see over the last 12 months, $54 million. Now, I realize that it says 84 and 148. This actually shows on here in millions of USD. So this is in millions here. Sometimes it's in billions, depending on how large the company is. Sometimes it's in thousands. So I want to see increasing net income. I want to see increasing revenue. Just because these companies or some companies don't have that, that doesn't necessarily mean, again, that I'm not going to invest in it. That's just a positive thing if they do have those increasing. Then I want to see some good cash on their balance sheet. So this is called the balance sheet. It shows, a variety of different things, but I want to see a good amount of cash. Now, how do you know what a lot of cash is? Because if the company is worth $10,000, it's going to have a much different amount of cash than if it's Apple and it's worth trillions of dollars. Well, something I like to look at is their liabilities. So you can take a look at the current liabilities. So you can get something called the current ratio, which basically is the cash and short-term investments divided by the total current liabilities. So anything over 1 is generally thought of as pretty good. If it can be 2 or 3 or 4, that basically means that they have a lot of cash. They could pay off all their total current liabilities. So this is stuff generally within a year of them having to actually pay it. And then you can also take a look at their total liabilities, right? If they have, let's say, just $1 million worth of current liabilities and they have $2 million worth of cash, but then they have $100 million worth of total liabilities, that's still not good, right? We want to be able to cover the short-term expenses and the long-term expenses. So from there, I want to see, okay, is their income increasing? Do they have a good balance sheet? What is their price at? And then you can take a look at some other things, which we'll get to in a second, which is, okay, all that is good. They have a good current ratio. They have good increasing revenue. They have good net income. But how do you determine if they're expensive or not? It generally depends on the sector that they're in. So we'll hit on that in a second. We'll talk about different kinds of investing, and you'll get an idea for what to look for some of these companies. Now, what are some red flags? Okay, red flags are huge valuations. So again, we'll talk about valuation, but let's say the company's worth $2 trillion and they're making $10 million worth of revenue. Now, that's never happened. There are only a couple companies with $2 trillion price tags, but let's say they're worth $200 billion and they're making $2 million worth of revenue. That would be a red flag. That's very expensive. Another thing is if they have no cash. What if they only have $1 million worth of money, but they have $20 million worth of expenses coming up this year? That would be very negative in my opinion. That means that they either have to raise more cash or they have to go get a loan, they have to issue more shares, or they're going to go bankrupt or something like that. So that could be an issue. And then bad reviews on products. So is the company actually got a good product out there? It doesn't matter how much money they have or how much they're making in revenue. If they have a crappy product, it's probably going to be bad for them long term. Now, I guess there are always extremes, right? But if I am investing in some company that everyone that uses it hates, that means that they're not going to have returning customers. That means that they're going to have to go get new customers. That means that they could possibly have, litigation against them. They could have lawyers suing them. It's not going to be good for the company. You want companies that people really like, that have good products, and they're able to sell and maybe not even market themselves. We want companies that are so valuable that their customers are talking to other people to buy it. Like some of the products you have, like an Apple iPhone or, some pizza place that you like. Like you're doing the marketing for them a lot of the time when you're with your friends. You're talking about how much you like their products, and it's less money that they have to spend to get new customers. So that is how I initially look into a company. Of course, there's more than that, but that is generally how I start looking into a company. And then let's talk about the different types of investing and investing strategies. There are many different types of investing, different types of strategies, including index funds, dividend stocks, growth stocks, value, SPAC and spec, penny stocks, meme stocks, crypto, options, day trading, swing trading, and long-term investing. Those are all different strategies. Now, just because you like one doesn't mean you can't also invest in other ways too. So you can have multiple strategies along your investing journey here. So index funds, it's a diversified basket of companies. So if you have the S&P 500, which is a very common index fund, you would have the 500 largest companies, or 500 of the largest companies. They're not always the largest companies, but 500 of the largest companies in the US. Now, again, there could be one that's maybe a little bit larger in market cap that's not included. They have their own criteria, but it is a basket of about 500 companies. Now, there are all different kinds of index funds with different numbers of companies and different sectors and stuff like that, but generally, it's just a way to diversify. So what are the pros? It's easy to understand, it's simple to invest, and it's low cost. So simple to understand or easy to understand, you're just buying a lot of different companies. So if one does really well, it brings up the whole group. But also, if you invest in one stock and it goes down, you lose all your money, or you lose a lot of your money, depending on how far it goes down, compared to investing in an index fund where people aren't as worried about risk, because what are the chances that all the companies in the US or the 500 companies you invest in all go down to zero? It's very, very low. Be pretty much an end of the world situation. Then it is just simple to invest in. You just put money in, you don't touch it. You don't have to worry about buying and selling all the time. You generally just put money in, hope that it goes up before retirement. It's low cost. Some ETFs and mutual funds, which we're not even talking about here today, they have something called an expense ratio, which is one of the common terms, and they are a little bit higher. So let's say you have a 1% expense ratio. That means every single year you're charged 1% for your funds. So that kind of sucks compared to something like an index fund, which usually is much lower. So if you had $1 million, instead of paying a 1% fee, which is $10,000 a year in fees, you would have something like a 0.04% fee, which would just be $40 or so off the top of my head. It might be $400, but either way, it's a lot less than mutual funds. So the cons, you typically won't get massive returns. I mean, the average return is around 9%. Of course, past results don't always indicate future results. So we could have higher or lower returns in the future, but you're not going to go out and get a 30% return year in and year out, which is typically hard to do anyways when you're investing in just individual stocks. But again, you won't get as massive returns as someone that is really good at investing in individual stocks. And there is some cost to it. If you invested in stocks yourself and made your own portfolio, you wouldn't really have to pay anything for it, assuming that you invest in a brokerage that doesn't have fees. And then some common terms, dollar cost averaging, or DCA, just means that you're putting money in over time instead of just throwing in a lump sum right up front, or maybe waiting a few years to invest or something like that, and then holding all this extra money and then waiting a few years to invest. So that is the opposite of dollar cost averaging. That is timing the market. And then you have expense ratio, which is how much you pay for expenses in your mutual fund, index fund, etc. So from there, we're going to go a little bit riskier, but not super risky at all, dividend stocks. So dividends, if you've heard of them, they're basically just direct payments of cash to shareholders from a company. Dividends are mostly paid out quarterly. Sometimes they're twice a year, sometimes they're one time a year, sometimes they're 12 times a year. There are all different kinds of ways to set it up, but typically it's every 4 months. The dividend investors typically look to generate income from stocks. So typically they're people that are closer to retirement age because they can get a steadier income as opposed to investing in growth stocks, which could go up 50% or down 50%. Typically, dividend stocks don't move as much. And again, you have constant dividend income. If the price changes, though, dividends don't change. This is something that's hard for a lot of people to understand. So if you have a $100 stock and it pays a $4 dividend, if the price of the stock goes down to 50 or 200, that doesn't typically affect the dividend at all. So you hear about dividend yield, that's a common term. Let's say you get a 4% dividend yield. That means right now for every dollar you put in, you get 4 cents in dividends, or every $100 you put in, you get $4 in dividends. The dividend yield is what changes with the price. So they might still pay the $4 dividend, but if the stock goes from $100 down to $50, that means 4 divided by 50 is actually 8%. So you would have an 8% dividend yield as opposed to a 4% if the stock was at $100. Then the ex-dividend date. This is the day that if you invest in that day, you don't get the dividend. So the ex-dividend date is the day that you need to have invested in before to get a dividend. So let's say we're paying a dividend, or some companies paying a dividend on June 1. They might say the ex-dividend date. So the day that you would have had to invest in it by might be May 15, because they don't want people just jumping in last second. So they do have it spread out over a couple weeks, so the price doesn't fluctuate, I believe, as much. Now, it still fluctuates. That's more my thinking, but there might be other reasons for the ex-dividend date not being on the actual day that the dividend is paid. From there, you can look at growth stocks. So growth stocks are ones that are typically expected to massively grow revenues in the future. So something that maybe isn't producing much earnings right now. Let's say it's $1 billion company and they're actually making negative money. So they're actually burning through more money than they are able to actually bring in. But the thinking is they're growing revenue quickly, so they should be valued higher, and they will have good returns in the future. A lot of biopharmaceuticals are this way, a lot of like electric vehicle stocks, and just stocks that right now need to scale to start making money. They're very tough to value typically because they change so quickly, and there are a lot of catalysts. These are not companies that have often been around for 100, 200 years. They have steady growth. They're kind of on this upwards trajectory, and it's hard to know where they will stop. Because let's say you've got a company that's at the bottom of this growth trajectory, and then it goes up to here, and then it stops gaining revenue. That could be the difference between being negative every single year, and if it goes up another year or two, and the revenue is able to increase exponentially for that last year or two, it can make them very profitable. So it's hard to calculate how much they should actually be valued. That's why a lot of people like investing in them too, because they think that Wall Street or larger investors might not know how to actually value them. It's important to calculate risk reward on these. So if you are investing in a pharmaceutical stock that you don't really understand, it's a growth stock, that one might not even be the best. That might not be the best example here, because that is not even really a growth stock. That's more of a spec stock. But let's say it's some electric vehicle stock, right? And it's one that's not Tesla. It's not any of the typical traditional car manufacturers. If you go and put all your money in it, that is very high risk. You need to weigh these out and make sure that you're diversifying in growth stocks, because a lot of these don't pan out. A lot of them do fantastic. It's hard to know exactly what things will do years down the line, because otherwise everything would be priced perfectly and we wouldn't have really significant returns in some of these stocks. So common terms here are P divided by S, price to sales. So this is how expensive the stock is divided by their annual revenue. So let's say it's a $100 billion company and they bring in $1 billion worth of revenue. That would be 100 price to sales. Growth stocks typically are valued at higher price to sales compared to, let's say, dividend stocks. They might be valued very differently because the thinking is the revenue will increase dramatically over the following years. And then you can look at forward price to sales, or forward P divided by S, which is basically next year, what will the price to sales ratio be based on what analysts are expecting for revenue. So that is what forward price to sales is. And it's based on today's price. Again, the price is the market cap. From there, we can take a look at value stocks. These are stocks that Warren Buffett has oftentimes invested in. They look for stocks that are undervalued. So you might look at price to book. So the price to book ratio is how much the market cap is compared to the actual value of their underlying business. So this might include different assets that they have. This might include cash. This takes into account several different variables. You can always look up the exact definition. And it basically tells you, okay, if they had to liquidate everything right now, would they be able to pay back their shareholders based on the assets that they have? And then you can take a look at price to earnings. So how much is the company actually earning? Is it a significant amount? If the company is worth $100 billion and they bring back $10 billion worth of net income, then the price to earnings would be about 10, because it's 100 billion divided by 10 billion. Generally, Warren Buffett has looked at companies that are lower PE ratios. Now, just because a company has a very low PE ratio doesn't necessarily mean it's a good, valuable stock at the current price. For example, if you see a company with a 1 PE ratio, it's almost a red flag, right? Because that is telling you that people are not willing to pay a significant amount for the company, even though they have great earnings, for one reason or another. And it might be because maybe their earnings were really high this year. Maybe some big contract happened and they have no other clients. There could be all different reasons for this. But a low PE ratio doesn't necessarily mean the company is being valued at a great amount or a great price. It might also be just because they're not going to grow as much into the future, so people aren't pricing in future growth, so they're willing to pay a little bit less for it today, which causes the PE ratio to actually go down. So higher, more expensive companies like Tesla or other growth stocks typically have higher PE ratios. This is one of the common terms. PE ratio, forward PE ratio, is next year's price to earnings ratio. Then price to book is what we talked about too. Then we have SPAC stocks. So SPAC stands for Special Purpose Acquisition Company. So this is a way of going public. It's a way that a company can buy part of a private company and take them public. So one reason that companies might actually do this, as opposed to going and having an IPO or initial public offering or a direct public offering, which is a DPO, is because it's much easier to get one investor on board than go out to a bunch of different places, raise awareness of your stock and stuff like that. It's also a lot simpler too. So the paperwork right now is much quicker, much easier than to go and have an IPO. Some early investors get access at a certain price. The PIPE investors get to invest at $10 a share. And then usually it starts at $10 a share and then goes up from there. So a SPAC stock could be $100 or $10. And then eventually down the road, they will actually merge with that other company. They go public, and then you can start, then the company absorbs part of the other company. Now, you have to be careful about valuing these, because a lot of the time the market cap that's listed on different websites isn't the actual market cap of the company that they're buying. So let's say this company has $500 million and they're buying 10% of another company. The market cap might show up as 500 million, but the market cap of the new company that they're buying is actually 5 billion. So you just have to take that into account. A lot of the time you'll want to look at the investor presentation when they announce who they're merging with. Now, this has unique downside protection. A lot of people were excited about SPACs in 2020 because of the fact that they can actually be redeemed before they merge at certain dates for $10 a share. So if you buy this at $10.50 a share, the thought is that at the lowest, it's worth $10. So you have downside protection where it can only fall 5% or so before it hits its redemption value, which is how much it is actually worth, and you can redeem. You can call up your broker. There's a process around it at certain dates where you can call them up and say, hey, I want $10 per share back. So it kind of protects the SPACs from going down way below $10 before they merge. Now, sometimes they fall down to $9.90 or $9.80 or something like that, but generally they don't fall much lower than that because of the redemption value. From there, we can take a look at penny stocks. These are called penny stocks because they're under $5 a share. Typically thought of as riskier investments. Sometimes people talk about pump and dumps, which is where some group of people try to pump up the price and then dump the shares so that way they can sell at a higher price. They're easier to manipulate, these penny stocks, because they are lower market cap typically. So smaller companies with generally smaller market caps are considered penny stocks. Typically, they're also considered growth stocks because they are being valued pretty low. A lot of the time they are not earning a lot of money. So a lot of the time these companies are actually losing money. A lot of pharmaceutical companies are penny stocks, or like small electric vehicle companies and stuff like that. Typically very volatile because their market caps are lower. If someone buys or sells a large amount, it changes the price a lot more. A lot of people think of this as quick money and they see like 100% returns in a day, but you can also see 60, 70% declines in a day too. So you just have to be careful. There's usually not as much information about penny stocks as there is about other larger companies like Amazon. They have tons of analysts covering them. It's very well known what they're worth. Penny stocks are typically hard to value. Then we have meme stocks or meme stonks. So this is kind of a newer area of investing over the last year or so. They're very based on momentum. So a lot of the time we'll talk about like Wall Street Bets or the ape community. They get behind certain stocks that they think are jokes. Sometimes they aren't jokes. Like with AMC, a lot of people feel very strongly about it because of one reason or another, especially with hedge funds kind of screwing over retail investors. But a lot of people thought of this as a meme stock at first. Basically, it's kind of a joke, right? Some of these investors can get together a lot of the time and push up the price. Some people did this with Dogecoin, for example. This was like a meme crypto at first, and then sometimes they actually get actual use case, or they actually become more valuable for one reason or another. So people often jump on the hopes of a short squeeze. So a common term is a short squeeze. So basically what happens is there's something called shorts. People that are shorting the stock means that they are borrowing it from someone, they're paying to borrow it, and then they're hoping the price goes down because they sell it off as soon as they borrow it, and then they try to buy it back later at a lower price. So I pay someone, let's say I pay them $5 to borrow their stock, their $100 worth of stock, and then I go and sell it. And then let's say the stock was worth $100 and the price went down to $80. I could then buy it back and give it back to the original person along with that $5. Then I have $15 left over. So I don't necessarily have to have all the capital up front to do it. Now, a lot of people are jumping on these right now. Long-term meme stocks can be quite dangerous and quite volatile. The reason is a lot of the time they will go up because people are buying them. There's a community, but a lot of the time they fall down afterwards because who's going to hold on to a joke for 50 years? Most of the time people will want to take out their profits. So you have to be careful that you don't get in too late, but it's also a good way of making money because of something called the short squeeze. So when all these different people short the stock, eventually they'll need to buy back in. So if the price starts to go up, these people that are shorting the stock can lose unlimited amounts of money. So again, let's go back to that scenario where I pay someone $5 and then I get the $100 worth of stock and then I sell all of it. What if the stock goes up 100%? Well, then I have to buy all those shares back and I have to pay $200 for it. So I lost $100 and I had to pay to do that. So when that happens, if the price goes up dramatically, a lot of people will have to cover their shares. So they'll actually have to buy those shares back up, which causes the price to go up. So if the short interest is too high, if too many people have shorted the stock, it can cause a kind of frenzy, like a squeeze upwards where it happens very quickly because the price starts to go up. Shorts have to cover, they have to buy back their shares. And then retail investors see that it's going up because the shorts are covered. They had to buy more shares back. So then it goes up more because retail investors are excited that it's going up. And then more shorts have to cover and buy back their shares, which causes it to go up more. And it's kind of just this squeeze where retail investors are buying more and these shorts have to cover. And as this is happening, a lot of the time these shorts or other shorts actually want to get in because the price has gone up so much so quickly. They think no way that this can continue happening. So they'll actually add on to it, which if it keeps on squeezing, it can keep on short squeezing everyone out of it. So it's kind of this very quick explosion in price that can usually happen over a very short amount of time or even a few days. Cryptocurrency is something that we're not going to get too deep into here because this is for stock market investing, but I think we should just hit on it real quick. It's built on blockchain technology. Oftentimes, it's a technology that you can look up and verify transactions that happened throughout time. So everyone can see it. It's taken and actually approved and looked through buy all these different miners or different ways depending on whether it's proof of work or proof of stake. We're not going to get into it too much here. Just know there are different use cases, so not everything is used as a currency. There are different reasons to have cryptos, and different cryptos do different things, and it's kind of controversial at this point. This could be a 5-hour video in and of itself, talk about cryptocurrencies, but we're not going to do that today. It's just something where I personally am invested in it. There are ways to make money on it. If you guys want, there is a link down there to BlockFi. You can get an interest rate on your cryptocurrency all the way up to 10% on their platform. So I really like it. You can also get up to $250 of bonus just for signing up. I'll put it in the pinned comment down below. But it's an interesting way of investing. It's considered its own asset class now. At least some of it is. Like Bitcoin was considered its own asset class just alone, and then cryptos in general are kind of their own asset class also. Then you can invest in options. This is very different than buying stocks, and it's an agreement, it's a contract between a buyer and a seller. It's much more complicated than buying stocks because it's time oriented. So they expire after a certain amount of time. So let's say, we'll go through some of the common terms here. You have the strike price. This is the price that you are agreeing to buy or sell at. So let's say you buy a call. That's buying the option to buy a stock at a certain price. So let's say the stock's at $13 right now. I say I want to buy a call. So I want the opportunity to buy the stock at $14. I actually have to buy that right, and I have to pay to do that. So maybe the price to do that is 20 cents or something like that at a certain time. So the $14 is a strike price. I'm agreeing to buy it at that point. At a certain time, we have the expiration date. So maybe I buy this for 2 years from now. There are certain dates set out. So in that 2 years, I have to exercise the option or I have to sell it. So exercising the option means that I actually go through and I actually have to buy those shares at $14. So why would someone do this? Why would they pay to go buy a stock at a higher price? Because they can leverage themselves up. So you might only have to pay, like I said, 20 cents to have the option to do this. So let's say the stock price goes up to $20. Well, I have the right to buy them at $14 and I paid 20 cents for that. So I am able to buy it at $14 and I paid 20 cents. So my break even's $14.20, but they're worth $20 now. And I only had to put down a small amount to be able to do that because I only had to put down 20 cents per share to have that option. So you can make your money stretch a little bit further, but they often swing very, very quickly because of the fact that they have to do with time. They are time related. So there's a little bit more pressure put on you to have the price go up pretty dramatically short term. And also it has to do with price of the underlying stock, because if you buy something that's way out of the money, meaning that it's not even close to the current share price, let's say we had that $12 or $13 stock and I buy a strike price of $100, that is way out of the money. That means that that we would have to see a large fluctuation in price to actually see that be worth much of anything. So in the end, you have the expiration date, you have to exercise or sell by that date, and you have to pay the premium. So that's what you pay up front to have this option to buy the stock at a certain strike price. So again, that would be the 20-cent premium that we talked about. They're often sold in contracts that are 100. So they are always sold that way. You have to buy 100 options of shares on one contract. So that's not the best way to explain it, but when you buy one contract, it has to do with 100 shares. So you buy, let's say the premium's 20 cents, you buy one contract, you have to take that 20 cents and multiply it by 100, so that would be $20 for that contract. Then you can do something called swing trading. So you can try to buy a stock for a short period of time. So this might be something like maybe a couple weeks, maybe it's a couple months, but it's not long term and you're not selling and buying on the same day. So it might be even just a few days. So with swing trading, you have to be kind of careful. This is short term, so there's more risk typically than if you're buying something and you're looking very long term. This could, like I said, last a couple days or even a couple months. We could also look at long-term investing. So typically holding investments for 1 year or longer, you're looking at the fundamentals of the company. So balance sheet, growth, upcoming prospects. You're typically dollar cost averaging all the time in these long-term investments. If you like the company over time, you typically want to invest more in it as time goes on, and you don't look at short-term indicators like technical analysis. So one thing that people often get into is short-term investing or day trading. I'd even put it on here, but we should talk about it just for a second. So this is holding for one day, or maybe if you want to count it as 2 days, typically it's considered buying and selling on the same day, day trading. And a lot of the time people will look at technical analysis. So if we go back and look at something like this, right? A lot of people look at indicators and they'll look at the charts. So they'll look at the actual price of the stock to determine whether they want to sell it or buy it. So there are certain patterns that happen over time, and typically they continue to happen. So a lot of people try to read charts to determine whether the price is going to go up or down. Some people really like technical analysis. Some people don't think that's worth anything, but a lot of people base their day trading on that. Or if they think some big news is coming later that day, let's say there's an earnings from a company, they're going to announce how much they made. They might try to buy it that day and then try to sell it. You can take a look every 3 months. Typically, these companies have earnings and they have annual reports at the end of the year. So a lot of the time, these companies will announce, okay, what is the state of their company? How much did they earn over the last 3 months? How much have they earned over the last 12 months? And so on. What does their balance sheet look like? They'll give some explanation for what the company is looking like. A lot of the time, analysts will cover these and talk about whether they're hitting expectations or exceeding expectations. It can cause the price to go up or down pretty quickly in the short term. And then they'll often have a conference call to talk about their earnings report, and then analysts can ask them questions at the end. So let's talk about measuring risk. So depending on what investment strategy you go with, your risk management is going to be different. One thing that I like to look at for long-term investments is the 50% drop rule. If this company or this crypto or whatever you're investing in falls 50%, are you going to be likely to purchase more or to want to sell out because you didn't do the right amount of research? So if you want to buy more, that means that you probably have a pretty high conviction in the company or in the stock. Now, don't get me wrong. Sometimes you think you have a high conviction, and then once it starts falling and once people start talking about why it's falling, maybe it's some scandal in the company, or maybe people just overvalued it, or there are all different reasons for it to drop. Typically, your feelings towards the stock change a little bit. So you have to have high conviction once it starts falling, because if you're doubling down and it really is a bad company, it can continue to fall down. Maybe it goes bankrupt and you're buying more as it's happening. You have to be careful with that. But if it's a company that is very valuable and maybe it's being manipulated, maybe people are overestimating how bad the news is, maybe it's one of the best investments of your life to be able to buy it after it's less expensive. So that kind of tells you your conviction. Are you feeling very strongly about this company? Would you want to invest more, or would you panic sell because you didn't do research on it originally? Diversification is key, not just in stocks, but in sectors and asset classes. I really like to diversify in cryptos, in real estate, and in stocks. I think it's really important to stay well diversified because then you act a lot more rationally when things are falling. I also think one way to decrease risk is to have some money in cash, which we'll talk about here in a second. But I think that is really important too, to diversify that way. Of course, you don't want to put too much money in cash because then you can't get a high return on your investments because cash doesn't really pay much. And also you lose money due to inflation. So you have to be a little bit careful with having too much, but having some is important. And then what's your timeline, right? If you are measuring your risk, you're going to have to look at your timeline. If you're looking long term, your risk is probably a little bit lower, right? If we look at Amazon or Google, those will probably grow pretty nicely over the coming years. If we look at something really short term, that will increase your risk. So if we look at some company that's earnings are today and it's a growth stock and it could go up dramatically or fall down dramatically, that can change how much risk you're taking on, right? So what do you do if the market tanks? How should you handle volatility? First of all, I think you have to look at how much cash do you have on the sidelines. I typically like 10 to 20% cash. Now, I realize some people say that's too much. Some people think that's not enough. I think that's a sweet spot. And I like to put my money in things that are like cash. One thing that I did recently was when when the growth stocks were falling down, and I am pretty heavily invested in growth stocks. When those were falling down, I was invested in SPACs. So those were the companies that have that downside protection, and they were at $10 and they were not falling at all because of the redemption value. So they were staying the same. Growth stocks kept on falling, and it was almost a way that I could be exposed to stocks. So if the stock market went up, SPACs should go up. But also, it was almost like cash because I could sell them and put them into growth stocks. One other thing you can do is invest in stable coins. So you have to look at the risks reward of that too. But these are cryptocurrencies that don't fluctuate in price, and they often pay pretty good rates. So like I said earlier, on BlockFi, they pay up to 10% on some of their stable coins. So essentially, I treat that as an investable asset, but it's pretty much like cash. So it does take a couple days to get it from that account over to investment accounts, but it earns me 10%. Again, you want to be careful that you don't have too much in cash because that actually loses money over time due to inflation, but also you don't want to have too little that you can't buy dips if some great opportunity comes up. And then how do you know whether a stock will go back up? It's very hard to tell, right? In the end, there's no way of knowing what stocks will do for sure. But hopefully if you're diversified and you're measuring your risk, you pick 8 out of 10 winners, one that does fine, and then one that, probably isn't a great stock. But you do your best. Overall, you should have more winners than losers, which is kind of the point of investing, right? You want to pick the good stocks, but you can't always be right all the time. So how do you know if a stock will go back up? You never know for sure. However, if they have a strong balance sheet, if they have strong fundamentals, they have good growth, they have good margins, so they actually are able to make a good amount of money on the products that they sell based on how much they actually earn after the expenses. That's important too. But it goes back to the fundamentals on the company, right? Long term, anything can happen. Short term, but long term, hopefully the company does well. And that is the end of the video. So hopefully that helps some people just get a general idea of stock market for beginners and a little bit on crypto too, mostly stock market. Hopefully that helped. Let me know if you guys like these kinds of videos down in the comments. Thank you for checking out Webull. If you do want to start up and start investing, that is a platform I really like using. You can get 2 free stocks, just deposit $100 on their platform. And you can check out BlockFi down below to get an interest rate on your cryptocurrencies up to 10%. And get a bonus of $250 worth of Bitcoin just for signing up and depositing some money on their platform. Thank you guys. Let me know what you think about this down below, and I'll see you in the next video. Bye.